I love to run marathons, plus another 5 miles. My favorite distance to run is 50 kilometers, which is roughly 31 miles, and I like to run mountain races in lower elevation mountain ranges. I race in the Pacific Northwest and British Columbia. I have run through the Tillamook Forest of Oregon and up and down mountains in Washington, Vancouver, and throughout the Canadian Rockies. Coming from sea level in Southern California, it can be a rude awakening to run at higher elevations without suitable acclimation time. Each race requires extensive due diligence. I have to build a proper training plan with a running coach. I have to refine my race day plan of attack, but the most important planning steps come months before any of this. I take stock of all of the available races and comb over all the elevation profiles, seasonal temperatures, predator populations, river crossings, and more. This gives me a high-level perspective that always pays dividends on race day. The same is true for commercial real estate. It is important to plan. Before we embark on your company's real estate journey, I want to offer you a background of the national industrial market that will give you some high-level perspective. Here you will gain an introduction and better understanding of the market's major trends, geographic submarket comparisons, and prevalent industry trends. Key market metrics. The 2020 CoStar United States Industrial Inventory Report calculated the United States industrial market to be 17 billion square feet. To put this into perspective, if the total amount of industrial space were all consolidated into one gigantic warehouse, it would cover the entirety of Los Angeles and all of its 4 million residents under one roof. There's literally 52 square feet of warehouse space for every person in the country. The market is affected by a multitude of variables, and each year is different. Brokers live in this market on a daily basis. They are your guides, making sure that you know the trends in your market and that you are making comparisons that are insightful and simplifying the industry jargon and nuance. Here are the most relevant market metrics that will have an impact on your next commercial real estate project. Net absorption. Think of net absorption as how supply relates to demand. Supply factors include new construction deliveries, increasing supply, along with the demolition and redevelopment of older industrial property stock, decreasing the supply. Demand factors are related to the increasing and decreasing footprints of the companies that call industrial properties home. Increasing supply or decreasing demand can cause negative net absorption, whereas decreasing supply or increasing demand can have the opposite effect. Every year, the industrial markets oscillate between negative 200 million and more than 285 million square feet of net absorption. Seeing multiple quarters of positive or negative net absorption can help you identify if there's a larger trend within a market. Growth rates. In any given year and within any given North American city, the industrial lease growth rate changes between negative 3.8% and more than 6.2% on average. Lease rates fluctuate as supply and demand factors change. They can also fluctuate due to changes in capital inflows and outflows, economic shocks, investor confidence, industry structural changes, tax laws, and other legislation. Note, this is an annual change in the market's pricing. You will likely sign a multiple year-long lease with annual increases. Your lease contract's annual increases and the overall market's annual increases are two separate things. When these two separate increases become wildly out of sync, that is when there can be cause for concern for tenants and landlords alike.